In 2023, Fidelity quietly published a report on account behavior across 4 million retirement savers. The finding that stood out had nothing to do with returns. It had to do with timing. The people who ended up with the most money weren't the ones who invested the most. They were the ones who started earliest and changed nothing. 4 out of 5 Americans will never act on that. Not because they can't, because nothing about the early years of investing feels like it's working. Here's the gap. Most people believe that consistent saving, over time, gradually adds up. And it does, for the first several years. But that framing misses the actual mechanism. There's a specific crossover point, somewhere around year 17, where your money stops depending on you. It starts producing more in a single year than you manually put in. After that, the math runs itself. What does it actually take to reach that point on $500 a month? That question is what this video answers. And if you never understand where that crossover lives, you'll keep contributing, keep waiting, and keep feeling like the number isn't moving fast enough, because you'll quit before the system activates. My name is Alex, and if you've ever looked at your investment account after years of contributions and felt like the growth didn't match the effort, stay with this, because the problem isn't your savings rate. I'm going to show you exactly when the math shifts in your favor, and what kills the process before it gets there. Once you understand where the real acceleration begins, you'll stop measuring progress by the wrong number. The pattern always starts the same way, with a first contribution that feels almost insultingly small, and a year one return that makes most people quietly question whether any of this is worth it. That's where we're starting. Planting the seed. Most people think the hardest part of investing is finding the money. It isn't. The hardest part is staying in when nothing appears to be happening. Let's watch that play out in real numbers. Meet Ryan. He's 32, works as a project manager at a mid-sized logistics company outside of Columbus. He earns a decent salary. He's not careless with money. But every month, by the time the bills clear and life does what life does, there's never quite enough left to do anything meaningful with. Sound familiar? Here's what Ryan does differently. He doesn't find extra money. He redirects money that's already leaving his account and just leaves quietly. He audits his subscriptions. And this is worth pausing on, because the average American is currently running 5.2 subscriptions and spending about $69 a month on streaming alone. Ryan keeps 2. He switches his phone to a mid-tier carrier. He stops the weekly Friday takeout that he barely thinks about, but is somehow always $40 by the time it's done. No second job. No dramatic lifestyle overhaul. He finds $500 a month without actually feeling it leave. That $500 goes into a basic S&P 500 index fund. The S&P 500 has averaged around 10% annually over the last 30 years, including dividends. Ryan uses that as his working assumption, which is reasonable and historically grounded. So, year 1, Ryan contributes $6,000 of his own money. The market hands him back $221 in gains. That's it. Less than half of a single monthly contribution in return for 12 months of discipline. He checks his account in December and stares at it. He was expecting something that felt like progress. What he's looking at feels like almost nothing. That reaction is completely normal, and it's also the reason most people quit before this process ever has a chance to work. By the end of year 2, Ryan has put in $12,000 of his own cash. His account sits at $12,891. If you draw that out on a chart, his personal contributions are a tall bar. The market gains are a thin sliver at the top, barely visible. It looks honestly like the market hasn't done anything at all. But here's what that chart doesn't show. Underground, the root system is forming. The shares Ryan bought in month 1 are now compounding on top of the shares he bought in month 2, which are compounding on the shares from month 3. The structure is being built. It just doesn't look like anything yet. This is the part that almost no one talks about, honestly. The first 2 years of consistent investing feel like a bad deal. You put real money in, you get a number back that doesn't match the effort, and the rest of your life keeps moving. Your rent goes up, something breaks, a friend books a trip that looks incredible, and that account just sits there looking unimpressive. Ryan isn't failing. The math isn't broken. He is exactly on schedule. He just can't see it yet. And that invisibility is actually what makes the next phase so dangerous. Because by year 3, the account still won't feel like much. But the invisible forces working against Ryan are about to get louder. Inflation is quietly eroding his purchasing power. Lifestyle is pulling in the opposite direction. And his own biology is about to make a very convincing argument that none of this is worth it. That's the danger zone. And it's where most people lose. Nobody warns you that the most dangerous moment in a 25-year investment journey happens before year 5 is even over. Ryan is still in it. He hasn't quit. He's still moving $500 a month into that index fund, still watching the account grow at what feels like a frustratingly slow pace. But somewhere between year 3 and year 5, the resistance shifts. It stops being about patience and starts being about survival. Because now Ryan isn't just fighting his own impatience. He's fighting two forces that are working against him simultaneously, quietly, and without announcing themselves. The first one is inflation. The annual inflation rate in the United States is currently running at 3.8%, the highest it's been in nearly 3 years. That means every dollar Ryan holds in cash is losing almost 4 cents of real purchasing power every 12 months. It's not dramatic. It doesn't show up on a bank statement. It just quietly erodes what his money can actually do. The groceries cost more. The rent renews higher. The car insurance bill arrives, and it's not what it was last year. He's earning roughly the same amount, but the same amount buys less than it used to. Now layer the second force on top of that, lifestyle creep. And this one is sneakier, because it doesn't feel like a mistake when it's happening. It feels like progress. Ryan gets a small raise at work, 3%, maybe 4%. And almost immediately, without really deciding to, his spending finds it. A slightly nicer apartment because he can finally afford it. Upgrading his car lease because the old one expires anyway. Saying yes to a weekend trip he would have skipped 2 years ago. None of these are reckless decisions on their own. Together, they completely absorb the raise. A 2025 Goldman Sachs report found that 40% of households earning $500,000 or more still felt like they were living paycheck to paycheck. That's not a low-income problem. That's lifestyle creep, operating at every level of income, expanding to fill whatever space is available. So here's what Ryan is actually dealing with by year 5. Inflation is shrinking what his money is worth. Lifestyle creep is absorbing every income increase before it reaches the investment account. And his account balance, after 5 full years of discipline, $30,000 of his own money contributed, shows total market gains of just $5,800. $5,800 after 5 years. Meanwhile, people around him are doing what people do. A colleague just leased a car that costs more per month than Ryan's entire investment contribution. A friend just posted photos from a vacation that Ryan quietly calculated would have taken 3 months of contributions to fund. The comparison is relentless, and the account is sitting there looking like it has absolutely nothing to show for any of this. Here's the biological piece that nobody in personal finance talks about honestly enough. This impatience isn't a character flaw, it's wiring. Human brains are built to respond to fast feedback loops. You work hard, you see a result, the reward system fires. Investing at this stage offers almost none of that. The result is delayed by years, not days. And so the brain starts making a very reasonable sounding argument that maybe this money could just do something more visible right now. That argument peaks right around year 5. It's the loudest it will ever be. And it's also, almost to the month, the worst possible moment to listen to it. Because what Ryan can't see yet is that the account has been quietly building structural momentum the entire time. The shares from month 1 have been compounding on the shares from month 6. The reinvested gains are generating their own gains. Nothing about it is visible on the surface. But underground, the structure is there. And it is about to start showing up in a way that changes the entire emotional experience of watching this account grow. That shift, the moment when the math stops feeling slow and starts feeling almost automatic, is what compound acceleration actually looks like when it unlocks. And it happens faster than most people expect once you get past this point. Here's something that almost nobody explains clearly. The shift from slow to fast doesn't feel like a breakthrough. It feels like a Tuesday. Ryan pushed through the danger zone. He didn't touch the account. He didn't panic. He kept the $500 moving every single month, even when the balance felt insultingly small for the effort it represented. And now, somewhere around year 6, something quietly changes. Not dramatically, not all at once, but it changes. At the start of year 6, Ryan has contributed $36,000 of his own money. His single-year market gain that year comes in at $4,400. That number probably doesn't sound impressive on its own, but compare it to year 1, when the market handed him $221 for the entire year, his annual gain has now grown by nearly 20 times, while his monthly contribution hasn't changed by a single dollar. That's the mechanism starting to show itself. By year 7, the shift becomes impossible to ignore. Ryan puts in his usual $6,000 for the year. The market returns $5,300. Two almost identical numbers, except one of them required Ryan to show up to work every day for 12 months, and the other required him to do absolutely nothing. The account is beginning to pull its own weight. Not fully yet, but the direction is unmistakable. Now here's the part that should make anyone angry, because this is precisely the moment when roughly 6% of Americans with retirement accounts made early hardship withdrawals last year, a record high, up from around 2% before the pandemic. People are cashing out right as the engine starts firing. They've done the hard part. They survived years 1 through 5. And then, just as the math is finally beginning to work in their favor, they walk away. They take the small profit, call it a win, and completely miss what comes next. And what comes next is extraordinary. Think about what's actually happening inside the account during these middle years. The shares Ryan bought in month 1 are generating returns. Those returns buy fractional new shares. Those new shares generate their own returns, which buys more shares. Each contribution increases the principal, and any compounding accelerates growth by generating returns on both old and new money simultaneously. It is, by construction, a system that gets faster the longer it runs. Ryan didn't build a savings account. He built a machine. And machines, once they have enough fuel, don't need constant supervision to keep running. Around year 12, the machine crosses a threshold that changes how this whole thing feels. Ryan's account hits $111,477. Out of that, he personally contributed $72,000 over 12 years. The market generated the remaining $39,477. Think about that for a second. He put in $72,000. The account handed him back nearly $40,000 on top, without him lifting a finger for it. The friction of earning is starting to disappear. And here's what that actually means in practical terms. Ryan is 54 years old at this point. He's not rich yet, but for the first time, the account is doing something that feels qualitatively different. It's no longer a place where he puts money and waits. It's a place that is actively generating money while he sleeps, while he works, while he does everything else his life requires of him. This is what people mean when they talk about money working for you, not as a slogan, as a literal mechanical description of what's happening inside the account. The interesting thing about this phase is how boring it feels from the outside. Ryan isn't doing anything new. He's not checking the market daily. He's not making clever moves. He's just continuing. And continuing is, at this point, the only thing the strategy requires. But boring and powerful are not opposites. They can be the same thing, and they're about to become the same thing in a way that changes the entire picture permanently. Because what happens between year 15 and year 25 isn't just more of the same growth. It's a different category of growth entirely, the kind where Ryan's money stops keeping pace with his contributions and starts leaving them behind completely. That's what escape velocity looks like when it finally arrives. There's a number most investors never reach, not because the math doesn't work, because they don't stay long enough to see it. Ryan is now in year 16. He's been doing the same thing since he was 32. $500 a month, automated, untouched. He hasn't made a single clever move. He hasn't tried to time the market. He hasn't picked individual stocks based on anything his cousin forwarded him. He has simply continued. And continuing at this stage is no longer just discipline. It's becoming something else entirely. Watch what happens in year 17. Ryan's annual market gain that year comes in at $13,393. His manual contribution for the year is still $6,000, the same number it has been since day one. For the first time in 17 years of investing, his money is out-earning him by more than 2 to 1. He worked all year. The account worked harder. He traded time for money at his job. The account didn't trade anything for anyone. It just compounded. That is the crossover point. And once you cross it, you don't go back. Think about what this actually means in practical terms. Ryan no longer needs his contributions to drive the account forward. They help, but they're no longer the engine. The engine is the account itself, the $111,000 that's been sitting there since year 12, growing, reinvesting dividends, buying fractional shares, compounding on a base that gets larger every single month. The contributions are now almost a rounding error in the larger calculation. Here's where it gets genuinely strange. Ryan's biggest financial threat at this point isn't market performance. It's the moment where something goes wrong in the market, and he makes a decision based on fear instead of math, because a crash is coming. It always does. The three worst bear markets in modern history saw the S&P 500 drop nearly 57% in 2008, about 49% during the dot-com bust, and nearly 34% during the 2020 COVID crash. Every single one of those drawdowns was followed by a full recovery and new all-time highs. The investors who actually lost money permanently were almost exclusively the ones who sold near the bottom and locked in the loss permanently. Here's what a crash actually does for Ryan at this stage. When the market drops 30%, his automated $500 suddenly buys 30% more shares than it did the month before. He's not buying at the peak. He's buying on sale. Every month, the market stays down. Ryan's fixed contribution accumulates more shares at a lower price. A dollar-cost averaging approach can prove particularly powerful during falling and volatile markets, where you can buy shares at lower prices and position yourself well for an eventual recovery. The people who panic and sell are handing their discounted shares to the people who stay. Ryan is one of the people who stay. The only rule during a crash at this point in the journey is not to check the balance. Not weekly, not monthly. The number on the screen during a bear market is not a real number. It's a temporary price tag on an asset that history says will be worth more in 5 years than it is today. In 7 out of 11 historical S&P 500 drops, prices recovered to previous all-time highs within a single year. The account doesn't need Ryan to intervene. It needs him to leave it alone. And by year 25, after doing nothing more dramatic than leaving it alone, Ryan's account sits at $409,233. He contributed $150,000 of his own money over 25 years, $6,000 a year, $500 a month. The market generated the other $259,233. That's 63.4% of the final number, produced by time and compounding, not by Ryan's labor. He's 57 years old. The account is larger than most Americans will ever accumulate in a lifetime of working. And he got there by redirecting what most people spend on takeout and subscriptions, and then refusing to touch it. The math is done. The account exists. What remains is the question of structure, the specific decisions about where to hold this money, and how to make sure as little of it as possible disappears to taxes and fees before Ryan ever gets to use it. That's the blueprint, and it's simpler than most people expect. The math in Ryan's story is real, but the math alone doesn't protect you. Structure does. Most people focus almost entirely on the question of how much to invest. That's the wrong question to start with. The more important question is where the money sits and in what order it moves. Get that wrong. And a meaningful portion of everything Ryan built quietly disappears to taxes before he ever touches it. Get it right, and the government effectively helps fund his retirement without him doing anything extra at all. Here's the sequence that actually matters. The first move is the 401k. That's your employer-sponsored retirement account. And the only reason to act here first is the match. The average employer match currently runs between 4 and 6% of salary, and the most common structure is a 50% match on employee contributions up to 6% of pay. What that means in practice: if you earn $60,000 a year and your employer matches 50 cents on the dollar, up to 6%, contributing 6% yourself, $3,600, earns you an automatic $1,800 from your employer on top of it. That is a 50% instant return on the first dollar you invest, before the market does anything at all. No asset class on the planet offers that. Skipping it, because the account feels complicated or the enrollment form looks annoying, is one of the more expensive mistakes a person can make quietly. Contribute enough to capture the full match. Nothing more is required at this step. The second move is the Roth IRA. That's an individual retirement account funded with after-tax dollars, meaning the money grows completely tax-free and you pay nothing when you withdraw it in retirement. The contribution limit this year is $7,500, with an additional $1,100 available as a catch-up contribution for anyone 50 or older. For most people in their 30s and 40s, this is the most powerful account available. Ryan's $409,000 sitting in a Roth IRA isn't just $409,000. It's $409,000 that the IRS has no further claim on. Every dollar of growth, compounded over 25 years, is entirely his. The index funds go inside these accounts, not crypto, not individual stocks, not whatever sector a financial media headline declared exciting this week. A simple S&P 500 index fund, something like VTI or VOO, charges fees so low they barely register, holds 500 of the largest US companies simultaneously, and has historically returned around 10% annually over the long run. Boring is the point. Boring is the strategy. The moment Ryan starts trying to be clever is the moment he introduces risk that the math doesn't require him to take. The third account, if it's available, is the HSA, the health savings account. The individual contribution limit this year is $4,400, and the family limit is $8,750. Most people treat the HSA as a medical expense account. It is actually the most tax-advantaged account in the entire U.S. tax code. Contributions go in pre-tax, grow tax-free, and come out tax-free if used for qualified medical expenses. After age 65, you can withdraw for any reason and pay only ordinary income tax, making it function like a traditional IRA, with an additional healthcare advantage built in. Now here's the piece that actually determines whether any of this survives long-term. Ryan can have the perfect account structure and the right funds and still blow the whole thing in a single week moment. 3 behavioral rules. Close that gap. First, automate the contribution so it leaves the account before Ryan sees it. Money that doesn't appear in the checking balance doesn't tempt anyone. Second, when the market drops, don't look at the balance. The number on the screen during a downturn is not a fact about Ryan's financial future. It's a temporary price. Third, when a raise arrives, invest it before lifestyle absorbs it. Not all of it, but some meaningful portion. Redirect it immediately, before the new normal has a chance to establish itself. The structure is simple. The discipline is harder. But here's what makes it manageable. Once the automation is in place and the accounts are set up correctly, the system runs itself. Ryan doesn't need to monitor it weekly. He doesn't need to make active decisions every month. The whole point of the blueprint is that it removes the human from the equation as much as possible, because the human, left unsupervised with a slow-moving account and a fast-moving social life, is the biggest risk in the entire strategy. All of that brings us to the part worth sitting with, the actual takeaway from everything Ryan's 25 years just demonstrated. Here's what 25 years of Ryan's journey actually proves. The gap between people who accumulate real money and people who don't is rarely income. It's rarely intelligence. It's rarely access to some strategy the other side didn't know about. It's time, and the decision not to interrupt it. A few things are worth carrying forward. Compounding doesn't reward effort, it rewards patience. The account that feels broken in year 3 is the same account that becomes self-sustaining in year 17. The danger zone is not a signal to stop. It's confirmation that the process is working exactly as it should. Lifestyle creep is silent and continuous. Every raise that gets absorbed into a slightly more expensive version of normal life is a raise that never reached the account. The switch doesn't flip itself. Someone has to redirect the money before habit redirects it first. And market crashes, when they arrive, are not emergencies for someone with a 20-year horizon. They are discounts. One question worth sitting with as you think about your own situation. If the math works this clearly on $500 a month, what's the number that would actually change your trajectory? And what's currently absorbing it without you noticing?